Hey everybody, this is Buck Joffrey, Wealth Formula podcast host, and I am going to introduce you guys in a few minutes to a concept. Well, I'm going to introduce you to a few guys who are going to introduce you to a concept that absolutely blows my mind. It's called Velocity Plus. Now, the first time I heard about this was a few years ago when I had a colleague, a friend who was in the insurance business, had mentioned that this is an option for me given my net worth. And I didn't really understand it back then, so I didn't really follow up. And then a couple years ago, I read the book from Tony Robbins called, what was it? Money Master the Game or something like that. And Tony Robbins mentioned a very, very similar concept again, but then he didn't really follow up on it. And I couldn't really figure out why. And as it turned out, it's because this concept, for the most part, was a concept that was reserved for the ultra affluent, the ultra wealthy, and people who were, at least 20 million or more. And so it didn't make a whole lot of sense for Tony Robbins to spend a lot of time in his book talking about that. But he did. And the cool thing is that we in Wealth Formula have figured out a way, and we have partnered with a group of guys who've figured out a way to make this incredible concept that I'm about to go into available to you if you make as little as about $100,000, a little bit more than $100,000 a year. So, of course, that's not everybody, and that's maybe where you aspire to be. So even if that's not you yet, this is definitely worth listening to, because I guarantee you that less than 1% of the population knows about this unbelievable strategy in wealth creation. So what I'm going to talk about, and what my co-hosts here are going to talk about today, is an alternative to your traditional IRA or 401k, your traditional retirement account. And what I discovered was that in this world of the ultra wealthy, they're called LIRPs. And I don't want to give away any thunder here, but it's basically called a life insurance retirement plan. It's something that's really interesting and which you're going to learn about today. But let's go back to a concept that I think is really important to why I think this is an unbelievable opportunity for those who qualify for it. And that is that I always talk about wealth and that there's math behind wealth. Right? I mean, certainly there are multiple components, but at the end of the day, wealth creation has a certain kind of math associated with it. And the variables in that math, I always say, wealth is equal to the product of leverage and mass and velocity. So those are the three variables. You multiply them together and you have a magic formula for wealth creation. Mass is in our formula here is just a significant, how much money you can put into your investments. Hey, listen, if you're getting 30 or 40% return on investment, fantastic, but it's not going to do you any good if you've got no money to invest, right? So the point here is you have to put money in order to grow it, and that's obvious. Velocity is something a little bit different. Velocity is how quickly you can take those gains that you make from a given investment, turn them around and reinvest them, right? And the wealth advisors like to call this the magic of compounding interest. But make no mistake, it's not magic at all. It's very deliberate. And the only thing that you're doing there is you're moving your money quickly. You're taking your gains, reinvesting them. And then when you do that, you make even more gains. And then you make more gains. That's velocity. And then leverage. Leverage is the one thing that really, in some respects, is the key difference between the way that the affluent, the ultra-wealthy invest compared to the poor and the middle class, and to a certain degree, high-paid professionals who are investing like the poor and middle class. Leverage is using other people's money. Now, that could be bank money, that could be loans of any kind, but using good debt to amplify your returns. And when we put it together, wealth is the product of mass and velocity and leverage all together. And what you're going to see here is that this product creates this entire mathematical equation and puts it in a box, puts it on a platter for you and makes it very, very easy to simply use the math to make money and create, long-standing income for you in retirement or, even before that. So what you're going to see here is unbelievable. For those of you who know me, know that I don't generally like investing in the stock market because I don't like losing money. I don't like the downsides. I don't like every decade losing 20, 30% of a portfolio unexpectedly and for no reason other than a bank failure that involved nothing that I was invested in. But you're going to see in this product, you're going to see something where you can take the majority of the upside of the stock market and not take any of the downside. That's right. Again, let me repeat that. You're going to take most of the upside of the stock market, and if the market crashes by 20, 30, 40%, like it very well may, you don't have to take any of the losses. Okay, and now it gets even better. Because you don't have to take losses, there's lots of people who are interested in lending you money to do this. The banks are. So what you're going to do is you're going to leverage the upside by using bank money. And that is going to amplify your returns even more. And in a nutshell, what this is going to do is it's going to give you exposure to the equity markets, the stock market, without downside risk and with your upside amplified. Now, who doesn't love that, right? So that's my introduction. That's why I'm completely blown away by this. And I want to turn this over to go into more detail now with my two experts on this topic. The first is Christian Allen. Christian is his areas of expertise include wealth formula banking, which we talked about in another webinar. And this product, which is Velocity Plus, he also works a lot with high net worth individuals with advanced strategies. So if you're one of those people, he's definitely a guy you want to talk to. Rod Zabriskie is the other host. Now, Rod is also an expert in wealth formula banking and Velocity Plus, and he has a special interest in retirement income planning as well. Both of these guys are unbelievable, have been in the industry for a long time, and some of the smartest guys I know, and have taught me an incredible amount when it comes to these really interesting products. So with that, I want to turn it over now to Christian Allen. Christian, thanks so much for being on the webinar today and explaining this exciting concept.
My pleasure, Buck. Thanks for having us. I think that was a fantastic introduction. I think you hit on all of the major key points. So what I want to just really quickly start by doing is making sure there's clarity in exactly what it is that we're doing. So the whole concept today is going to be based on allowing us to use other people's money to generate income. Again, what can be better than using other people's money to create value for ourselves? So what's happening here is that we're going to contribute something to this plan, and a bank is going to contribute even more than that. And so it's kind of a really unique, interesting thing. As Buck mentioned, this is something that has been around for a long time, but traditionally or historically only available to that very high net worth grouping of people. So we're super excited about the fact that a lot more people today now have the chance to take advantage of it. So anyway, just keep that in mind as we're going through this conversation, that there's two pieces. There's a contribution that we make, and there's an even larger contribution that the bank that we're partnering with on this actually contributes to the plan. So the purpose of this whole strategy, the purpose of Velocity Plus, is to create as much income as we possibly can using as little amount of money as we can. And as Buck said, it's really a strategy that fits as a replacement, as an incredibly effective replacement for some of your traditional retirement accounts, right? So I'd be super excited if my IRA over the next 20 years returned me a 7 or 8% average return, right? Most people would feel really great about that, and that would provide some benefit from a retirement perspective. And then I might even be able to get some, I'd get some tax benefits if I've got it inside of an IRA or Roth IRA or whatever. Here, what we're going to show is the ability to put in less money to get a much greater return and produce significantly more income. So the purpose again is to replace those other more traditional retirement accounts with a place that's really effective. So this is 401ks, traditional IRAs, deferred compensation plans. And one of the things that's unique here is it can even be done in a group basis. So for any of you that work in some sort of partnership group or have an organization, this is a strategy that can be considered and potentially even used on a group basis, which adds some additional benefits. We're not going to get into a lot of that today, but I just wanted to throw it out there for those of you that fit that criteria. So now that we understand the basic purpose of Velocity Plus, the first thing I want to start with is the structure, right? So I've talked about how the bank is going to contribute to this plan. What's really happening is that there is going to be a funding time frame. In other words, a contribution time frame of 10 years. Now, the first 5 years, I, as the investor, as the policyholder, contribute a portion of the money, and then the bank is going to match that money dollar for dollar, or maybe even a little bit more than that. And then once I get through the 5 years, I'm literally done putting money into it. So for you as an investor, this is a 5-year contribution, and then it's a complete stop at that point. Now, what's going to happen is the bank is going to come in and they're going to contribute both their contribution, and they're then also going to cover the contribution that we're making as the policyholder or investor. So what ultimately happens is that we have a leverage component or a leverage ratio of 25% of the money coming from us and 75% of the money coming from the bank. Now, any of you who are in the real estate world or who are interested in it understand the value of leverage as a whole, and that's really what we're building on, right? So I could use, $100,000 and that I've got in the bank, and I could go buy a piece of real estate. And yet, why wouldn't I, to the extent possible, take that same $100,000 and go buy 4 pieces of real estate? And that's really what we're talking about here. We're talking about using this money and buying 4 times the value, but instead of doing it in real estate, here we're doing it inside of a life insurance structure. And maybe I should talk about that for a second. I'm just going to go into the type of product that we're using. So we're using what's known as an index universal life, and Buck hit on the basic parameters here, right? So the idea is that we're going to cover, or we're going to capture about 80% of the upside inside of this product, and we're going to completely eliminate the downside. Now, some people will say, hey, this sounds too good to be true, right? And the reality is it's just that it's a lack of understanding. So what's really happening here is that I'm basically giving up a small portion, a small guaranteed or fixed interest rate, and instead using a portion of my money to buy an option, which then goes and buys me the ability to get 80% of the market. What's really cool about this is that as things change, as interest rates go up, that same dollar, that same option could potentially purchase me 90% of the upside of the market, or even 100% in a roundabout way. We'll get into this in more detail when we talk to individuals on an individual basis. But the key thing to note here is that we've got a cap and a floor from an earnings perspective. Our cap right now is going to be around 12.5%, and we're going to have a floor of 0. So what does that mean? It means that if the market tanks and goes down by 20% in a singular year, I'm just going to get a 0% return. I don't lose money, but I don't gain it, right? So again, if you look back at 2002 or 2008 and you said, hey, I went through those time frames and where the market just plummeted, and I just ended up even in those years, but then the next years in these corrections, I was able to capture 80% of that. I think most of us would feel really good, and that's essentially what we've done over the past 10 years using this exact product. So, and then on the upside, we've got this, say, 12.5% cap. Well, put simply, if I earn whatever I earn in the S&P 500, as an example, I would get up to 12.5%. So if I get 10, so if the S&P performs at 10%, they're going to credit me with 10. If the S&P performs at 15, I'm going to get 12.5. One thing I ought to just really quickly make clear is that we're not actually investing in the market here. And this is a really important distinction. So what's happening is that rather than investing directly in it, we're using this option that I mentioned. So they're taking and looking at the earnings of an outside index and then crediting our account according to that. Now, what's interesting about insurance companies is they don't really care what's happening outside of that, right? That option is going to buy what it's going to buy. At the end of the day, they're going to get their money regardless. So this product ends up being incredibly profitable when we add the component of leverage, which is what we're going to really focus on the rest of the way here.
If I could just kind of come in for a second here, Christian, just to point out a few things that
Sure.
I think just to emphasize. So first of all, I know that you may have heard people say that life insurance is a bad investment. I can tell you certainly from in my own case, coming out of surgical training for the first time, I had people telling me you don't want to invest in permanent or whole life or anything like that. You got to stay away because it's term, and then you invest the difference. But I want you to just forget that for a moment, because that is a concept that is what is typically presented in the context of a very, very different product than what this is. Don't even think of this for a moment as your typical insurance product, because most of the time it's not. It's really, really important. And it's kind of funny. I kind of think about this in the spectrum of the poor middle class, high paid professional, and then affluent, super affluent. It's like the people who don't know very much and who don't have a lot of money get talked into whole life or permanent life insurance products that are not good for them. That happens all the time. We see it all the time. It's terrible, right? And it's not just them, but it's also, high paid professionals who are doing well, but just don't really know what they're doing with their money. They invest in these permanent life insurance policies that are not good investments for them. Okay, and then the funny thing is that then you get people who know, well, gosh, I shouldn't invest in that. That's like the next tier up, right? I know enough not to invest in that. And so there's a level of sophistication there that they know that they shouldn't be investing in the bad insurance products. And then there's the affluent who know, wait a second, actually you can use various types of life insurance to really, hyper accentuate your ability to grow wealth and protect it, that the people who thought that term insurance was the only way to go don't know about, right? So it's like the spectrum of knowledge, which is just fascinating to me, because it's like, first, it's good, it's not good. Wait a second, it is good if you use it right. So the point of me bringing this up is you have to forget about what you've learned about the concept of investing in life insurance. We're talking about a completely different animal, one that virtually every one of my ultra high net worth individual friends use. So that's one thing. The other thing I just want to point out is that what we're really talking about here, and we're going to get into this more, I know, is that he's talking about, taking most of the upside. But what you have to really understand is when you add this leverage to this, you're taking pretty much all the upside. And that's where Christian's going with this. So Christian, anything to add to that?
I think it was great points. I appreciate you adding that context, because sometimes we get going and we miss some of those critical points, right? So I think that you really brought it home in a great way. Maybe just to add to that, the other thing that we're doing here that's unique from a life insurance perspective is that this is all about creating cash. So this product that we're showing is literally going to have the lowest amount of fees that you can potentially create in life insurance. In fact, because of the way we structure it, we're going to have this thing create everything that it's doing for under 80 basis points. So for those of you that are used to investing in the market, if you could get market upside, get some significant benefits, and you did it for 80 points or less, and we also have this death benefit and the tax-free benefits, that's pretty significant. So I'm glad that you brought that up, because ultimately this isn't life insurance like we generally think of it. And I'm lucky to work with a lot of high income and a lot of high net worth individuals. And I can tell you from my experience that there's nobody that fits into this category that doesn't use life insurance in some way, shape, or form as an asset class. And there's really not a more efficient way to do it than what we're showing here. So great points. Thanks, Buck. Okay, so what I want to do next is I want to fast forward and show the actual numbers. I want to get into the benefits of what we can create. And then what we're going to do is we're going to circle back around and show how we actually create that benefit. So to do that, I'm going to turn some time over to Rod and let him dig into some of the numbers. And like I say, then we're going to circle back and we're going to talk about how we actually did it, so that you're not leaving thinking, seems too good to be true, can't understand how it happens.
All right. So in order to do this, what we're going to do is we're going to look at a case study. And Christian already talked about the basic structure of how the money goes into the policy, but let's just throw some numbers to this. So on the left-hand side, we can see what the investor, the policyholder, is contributing. So we're showing an even $50,000 a year for 5 years, so a total of $250,000 going in on their side. During those first 5 years, the bank is also going to contribute roughly the same amount, a little more. And then, as he mentioned before, from years 6 to 10, then the bank takes over and contributes the entire amount for those 5 years. So by the time we're done, we have about $1 million total that have gone into this plan, but our portion of that is just that $250,000. At that point, it's fully funded. No more money is going to go into this plan. What's going to happen at this point is it's going to be allowed to grow for another 5 years, and then we're going to pay the bank back. Okay, and we'll get into a little more detail on how that piece works. But ultimately, the bank gets theirs. They're happy, and then beginning at age 65, and from 65 to 90, for this example, we're going to start taking off a tax-free income. And with this $250,000 that we've contributed, then the income that we're going to be taking off from age 65 to 90 is $115,000 per year. And so you can see already kind of the power in this. But just to quantify that, we're basically looking at a total of just under $3 million coming off of this plan, tax-free.
So to me, this is incredible, right? So what we're suggesting here is a pretty bold claim. We're suggesting that by putting in $250,000, $50,000 over 5 years, I can reasonably expect to get $3 million back out tax-free. Is that right?
Right. And part of what's happening is the time value money. But just so you know, for this example, we're not saying this is a 20-year-old doing this. We're talking about a 46-year-old that is contributing these funds. And so quite literally, 20 years later, they're starting to take this income off, and it's still this powerful, this large number.
Yeah, and the other thing, guys, is that the leverage that you use there, just for context, you used, I think, 3-to-1 leverage, right? And I know that that's sort of the, for high-paid professionals typically who are, six-figure earners, that's your typical leverage. But can you comment, because there are situations, like how elastic is that the amount of leverage you can get? Because as I understand it, the 3-to-1 is sort of just the tip of the iceberg, right?
Sure. Yeah, I can comment on that. And that goes back to your kind of high net worth world. Now, and maybe one thing I should comment on this is that this strategy, because we're actually making a contribution, is really, really sound. It's really stable. What ends up happening is that for the right person, there's quite literally a possibility to use this same concept where instead of putting in 25% of the funds, I might be putting in actually no money and rather just putting up collateral. Now, there's still something on the line there, right? There's collateral that I have and I should put this out there too, Buck, because one of the things that people oftentimes think is that if I'm putting up collateral, I can use it in no other way. But I could literally still invest in some of my traditional types of investment accounts. I could invest my collateral in that and still use it to create this other asset class. So anyway, to go to your point, there are situations that we run into where, and if you fit into this category, we'd certainly love to talk to you about it and help you better understand how you might be able to use the same strategy with no contribution out of pocket and only using collateral.
Yeah, and that's not going to apply to most people. That's going to be people who are generally over 10 million in net worth. But we have seen, we have a fair number of people in our group actually who've already, including myself, who are taking advantage of that. So I just want to bring that up for that purpose and sort of, you know, make sure we cover it. But for most people, that 3-to-1 shows us some impressive numbers as you're showing. So.
Yeah, that's a great point. I'm glad that you brought that up. And like you said, I want to emphasize, like, there are people, by the way, that we get into who are really looking at it as an income play, who might be in the 10, 15, $20 million net worth, and they might use both strategies, right? Because this is a really solid income play. And so from that standpoint, it's not that one's necessarily better or worse. It really just depends on a given situation and what we're trying to do, how we're trying to create value for an individual. So yeah, great point, Buck. I'm glad that you brought that up. The next thing that we want to kind of move into and talk about, and I'll just hit on this really quickly, is Rod mentioned there that we're going to be utilizing leverage from the bank for a total of 15 years. And obviously there's well, let's put it this way. There is a rhyme or reason behind that 15 years. The reason is that the company that we work with on this has actually done significant back testing, and it has been able to show that over a 15-year time frame, we've always been able to outperform the loan. Let me back up for a second. So obviously, if I'm using a bank, then I'm accumulating a loan, right? The whole strategy that we're talking about here is based on earning more interest in the policy than what we're paying on the loan. And what's really unique here is that in every 15-year period of time, that 2% spread or better has come to fruition. So that's why they use that 15-year time frame. But what's really unique here, and what Rod's going to talk about next, is the fact that we're not just using leverage for 15 years. We're going to utilize this leverage for the duration of our policy, really for our entire lifetime. And that's where it becomes really powerful and really unique.
The power of using leverage, we want to continue to use it, right? So we're grateful, you know, to have the structure to be able to use the bank. But when we pay off this bank loan, we're actually going to do it using a policy loan. And for any of you who are familiar with the wealth formula banking strategy, we get into this in a great amount of detail. But real quickly, life insurance cash value, when I'm going to take a loan against my policy, that money doesn't actually come out of the cash value of my policy. The money that's coming to me is actually coming from the general account of the insurance company. What that means is that the full of my cash value is all still there, continuing to grow and earn interest and compound even while I have this loan out. So in this case, for this IUL product, my cash value is there receiving these interest credits of anywhere between the cap and the floor. Looking back historically, conservatively, we're looking at an average of about a 7% credit to that total cash value, even though I have a loan outstanding. Just to illustrate that, let me just throw some numbers up on the screen here. So let's just take a snapshot in time, and we're looking at this point in time where we've just paid off the bank loan using a policy loan. Okay, and so based on these numbers we looked at just a minute ago, where we had contributed a total of $250,000, at this 15-year mark, we pay off the bank loan. First thing we're going to look at is our total cash value. At this point in time, it's going to be $1.8 million. The loan balance at this moment is going to be $1.2 million. And so therefore, the net cash value, or in other words, our net equity in the policy, is $600,000. Okay, so with those values in mind, let's just say that the next year the S&P goes up 10%, and so we're going to receive a 10% credit to our account. that 10% is going to be calculated off of the total cash value. And so I'm going to receive $180,000 credit in that year.
You know, what's interesting here is that most people, when they see this, this is kind of the aha moment, right? Because what's happening here, when we ask this question, well, where am I going to get the cash value credited from? A lot of people assume that it's the $600,000 net cash value number. So they're saying, oh, great, well, I'm going to go up by 10% or $60,000. Well, that's actually not the case because of this, the way the life insurance works, because the cash value stays intact, that loan value is actually working for us. It's our friend in this case. And that's why these numbers become so significant.
Yeah, great point. And so at the same time, our loan balance is going to increase. Let's assume it's at 5%. So my loan has gone up 60,000, and I worded that way because we're not making payments toward the loan in this example. We're going to just allow that to accrue and grow. So it increases by $60,000 in that year, but that means that my net growth in my cash value for that year is going to be 120,000. So in other words, we were at 600,000, we grew by 120,000. So my gain in that for my net equity was a 20% gain for that year.
To me, this is really significant, right? So we're suggesting that I can have $600,000 net value in my policy by gaining 10% inside the product itself. This is where Buck talks about this amplification. We just amplified that 10% return to literally do double what it would have done otherwise. So now I can grow by $120,000. Well, tell me this, how many people out there wouldn't feel incredibly excited about having $600,000 in the next year, turning that into $720,000? I think most people, regardless of what type of investor you are, would feel pretty good about a 20% return. Now, we realize this isn't going to happen each and every year, right? But what we're suggesting is that what we're putting out there is something that's actually much more conservative than the numbers here. So in other words, even if this happens or something like this happens half the time, we're very easily going to increase or create that 2% spread that we need to create in order to create the value that we want to accomplish.
And just to add one point, I do encounter a fair number of professionals who have had this concept of index universal life, which is the product we're sort of getting at here. They've had this explained to them, but I've never really seen anybody who's seen it with leverage. And that's why we call this Velocity Plus, because again, it's velocity because you're getting the exposure to the market with market upside. So there's velocity, but most people are okay just taking that 12 to 13% and calling it a day. What we're doing here is saying, well, hey, you don't have to settle for just 12 or 13%, because if the market goes up over that, you've got leverage on top of it. And so you're actually going to get more than that. You might get 19, 20%, right? Which is, I think by any measures in the S&P 500 or Dow Jones or whatever, it's a very good year. So that's what I think. That's what we're really excited to point out to people, that this is a very unique product, and this is, I talk about this sometimes where the ultra wealthy don't hope with their investments, right? They engineer the outcome, and that's exactly what this is.
Yeah, that's well said. I think that's a great point. So interestingly, you use those numbers of 19. Well, when we go out and we play out the exact scenario that we showed out here today, I would have to get an 18% annualized return every year from the time I started in it through the time that I used that income. So that income stream literally created me an 18% return compounding, and it didn't take some astronomical, incredible market performance. It just took very average, even conservative market times in order to build that out. And that all comes to fruition because it's been engineered, like you said, utilizing the amplification component, the leverage.
So just wanted to point one thing out here too. In this model that you're showing, that comes out with effectively what 19% IRR or whatever, you are using pretty historically conservative numbers here. I mean, it looks like 7%, right? I mean, that is another thing to point out. I mean, I think this is a pretty conservative pro forma. I mean, you very well could end up doing quite a bit better than that. Is that right?
Yeah, I think it's a great point. In fact, for anybody that's been inside this product for the last, 8-9 years, it's been obviously substantially better than that, right? Because interest rates have been low and the market's done really well. It's been bullish. So the combination of those two things has just been an incredible, instead of getting a 2% spread like we're showing here, they've been getting a 5 or 6% spread on average. So yeah, you're exactly right. And we really like to be conservative because for most of the people that we talk to, it adds kind of an additional layer of comfort. So they can know that they can go into this, let it work as this investment vehicle that's creating velocity in a box like we talk about. And they don't have to worry about it. They can know that over the long haul, this thing is going to perform, and it's going to perform in a really significant way. So yeah, that's a really great point, Buck. We try to be really conservative with the numbers so that we can, rather than overpromise and underdeliver, we want to do the opposite and make sure that we're underpromising and over-delivering. So great point. A couple quick things that we want to hit on, kind of in line with this conservative nature of the approach that we take. We don't want to pretend that there is no risk that exists here, right? So there's a couple of key risk factors that we want to keep in mind. So it's not a matter of not having risk. The question is, what have we done to mitigate those, or how have we planned for those types of situations? There's two primary risks that we run into. The first one is high interest rates. The second one is really poor market performance. And so when I talk about high interest rates, I'm not talking about, a little bit of time where interest rates go up and then come back down. I'm talking about a time like the 80s where interest rates were consistently high year over year, right? Because now we have a high, when the loan that we're paying on ends up being more expensive for us. So what the cool thing here is that what we've done is we've actually run scenarios to see how our strategy holds up even in the worst economic situations. So again, from a risk factor, we have high interest rates, which is the 80s. And then we have, from a market standpoint, we have the risk of what took place in the Great Depression. So we actually have done some stress testing to say, how does this strategy hold up in kind of the worst possible situations? And Rod's just going to really quickly hit on the numbers and talk about what happened during those times so that anyone listening to this doesn't have to feel like, hey, they're only hitting on the best case scenario. Let's just for reference point, let's also hit on the not best case scenario, maybe even a worst case scenario.
Yeah, some of these extreme examples of using historical events. So in doing this, what we want to do is let's go back to the baseline, the income that we were showing earlier of $115,000 a year from age 65 to 90. So if that's what we're looking at based on our assumptions, let's look at what it would be if on this high interest rate scenario, we were to take out a policy in the late 70s, just before this run up of high interest rates. And let's say they even get as high as 15% for this bank loan. Well, the change in our income as we play the scenario out would end up where we would be at about $98,000 a year for those 26 years. So a measurable difference, and yet again, maybe considering the extreme nature of the situation, surprisingly still strong. And then the other example we're looking at with this poor performance, and we're going to look at the Great Depression because in an individual year like a 2008 where we see the market drop, like we've already talked about, we've seen many good years since then of recovery and pushing beyond, right? And so normal volatility actually can be favorable in this kind of situation. So what we're actually talking about is an extended time frame where the market is down or level.
Yeah, and I think this is really, again, a critical part, because if you look at 2002 and you look at 2008, well, we had a couple of down years in both of those situations, but then we had extreme bull markets. So running through those actually ends up being incredibly valuable for us. What we want to be planning for, though, is an even more challenging situation. And that's where we get into the numbers that Rod's going to talk about that would result if we actually experienced a Great Depression. And I think what you're going to find here is that it's still pretty darn impressive.
Yeah, so in this case, we're starting this strategy shortly before the Great Depression. And as it plays out, then the projection for income would be about $78,000 a year for those 26 years.
So what we've shown here is a conservative approach at the 115, and then we've shown two of the worst or most challenging situations that we could potentially come into in the history of America. And either way, we're ending up in a really positive and strong situation. So again, if we wanted to say, hey, what happens if the market does really well, then these numbers even get more dramatic. So anyway, like I said, I want to make sure that we're not ignorant to the fact that there are risks that exist, but here's how it plays out. It ends up being that it's really, if you fund for the 5 years, it's impossible to lose money on the deal. And even in the worst economic situations, we're really doing something pretty dramatic, because if I looked at, a retirement account where I got an average 8% return over the exact same time frame, I still wouldn't be able to produce that 74,000 or the 98,000. So anyway, again, it's just really significant. What we hope people will catch from this webinar is just that there are other unique opportunities that are available to more people. And our hope is that you'll take the opportunity to learn about them and see how they could potentially be valuable for you. So with that said, I think we covered most of what we wanted to. Buck, is there anything else you wanted to add or go into?
Yeah, let's do that, and then we'll take some questions here. One thing I wanted to just add is, to your point, I think it's really a strong point to bring up, because I think there are so many. For some reason, and we can talk about this in a minute, but there's the whole people who sell or who are brokers involved in the whole life insurance business or wealth formula banking type product that we also talk about. For some reason, it seems like they're real negative about this product. And I think what I have discovered, and what I, as an investor and as somebody who's interested in and just putting my money to work, is that it's really not. It really seems like these divisions, unfortunately, really come on down the lines of what product that the particular agent is actually involved with, not so much the merits of the product itself. And that's one of the things I really do appreciate about Rod and Christian, is that they're really coming at this with a holistic approach and saying, hey, I'm not going to just be involved with one product and tell you that that's a better product. And this is a critically important thing, because you're going to hear people on either side of this say, this product is better than this product. And what you're going to get if you watch this, watching this webinar now, and if you go back and watch the Wealth Formula Banking webinar, is two fairly strong, webinars just on the merits and the downsides of each given product. So that's one thing I want to say, and you can comment on that in a second. But the other thing is that, who is this product for, right? And this is something that I think is important too, because a lot of my listeners on Wealth Formula Podcast, my investor group, we are, for the most part, a lot of us are cash flow investors. And so this product is not ideal for somebody who's wanting to use this money in particular for cash flow investing. But for me, this is another way to get exposure to something that before, the stock market, that I wasn't terribly interested in because of the downside. So to me, all this is okay. I have to, in my, if I'm looking at this, I just have to contribute for 5 years. Right. And the rest of the time, it's basically just happening in behind the scenes. It's just creating money for when I want to retire. Now, I'm one of those guys, I don't know, there probably are a number of those out there who think, well, gosh, I'm 44. I want to invest for now and make a lot of money. and I don't want to put this money, and I don't care what, 15, 20 years is a long time from now. Well, guess what? I wish I'd done this 15 years ago. The point is that, it's a contribution for 5 years, and then it's just set it and forget it. And next thing you know, you've got a bunch of money sitting. That's the way you got to approach this. And that's why I am very bullish on this concept. But those are the two things that I have to add. And I don't know if there's anything you want to comment on that before we get to questions here, Christian.
Yeah, maybe just one thing to add to that, or just a couple things to a little bit of commentary. So first off, Rod and I came from the whole life world. We fit into this world earlier on in our career. And what we found is just that the extreme bias towards one product or the other wasn't necessarily doing what's right for the client. And so what we did is we said, all right, we've got to step back here and really look at the best interest for the clients that we're working with and figure out how we can create value for them. So we've done an enormous amount of due diligence on this product, specifically Index Universal Life, that's being leveraged to create or to get to a place where we feel truly comfortable. So we know this inside and out. And the reason is because just like some of you might look at, maybe you have a bias toward one or the other. What we want to do is hopefully take down the bridge that divides and show you where the value is in both. So that's the first thing. And then to your second point, what we're finding is we're meeting with a lot of your audience is that they love what we're doing from a wealth formula banking standpoint, but most of them find that they really like the idea of having a portion that's working for them, that doesn't require their active effort. So I think that these two products really work in tandem with one another in a really great way. So all of the points you made were spot on, but I do think that for most people, there's really a place for both strategies inside of their overall financial world.
Yeah, just one little add on there. This product, the way this is with the indexed index to the S&P 500, this is the product that I see more of my ultra wealthy friends using than the other one. And part of that is because of the fact that, they are busy, and as much as we all, a lot of us really want to be constantly investing in cash flowing assets like apartment buildings and stuff, this is a set it and forget it turnkey product, right? This is a wealth formula in a box. And so I think that's a real value to people who are real busy out there and who might really like the idea of getting invested in cash flowing assets, but may not have the time. And so you could do what I'm doing. I'm doing both. I'm going to do both of these types of accounts. So that's one thing. So with that, I'm going to go into some questions here for you from the audience. First question is the bank interest rate used for leverage, does it depend on the market, or is it fixed or variable? Basically, that's a question.
Yeah, great question. So we use a rate that's known as LIBOR, and you can look that up to see where it's at. Right now, it sits just under 4%. It sits at more like 2.5%. And then the rate that we're ultimately going to pay is LIBOR plus 1.75. So that's one thing so generally speaking, right now we're going to be under 4%. The answer to your question is that we lock it in for 1 year at a time. Now, what's interesting here is that we have 17 banks who are basically competing for our business. So the value that we get by having those 17 banks is that we can easily flow that loan to whoever is going to be most competitive. So anyway, to answer your question, it floats on a yearly basis. We'll reshop it each year, and we'll get the lowest rate that we can possibly get based on that competition factor that's been created.
Great. Let's go to the next question. This kind of goes back to what I was telling you about before, which is sort of misinformation that's out there from people who are not involved with this product. It says, but I thought IUL, which is Index Universal Life, which is the premise of this, is essentially term, and gets expensive over the years, and essentially cost of insurance increases as one ages, unlike whole life?
Yeah, great question. So the reason that this is dramatically different and doesn't apply to that exact, well, so let's put it this way. If I were to just go and purchase a traditional policy from my local agent on the street that's unaware of how to put these together, then what they're saying there would be accurate. But what's happening is that we're maximizing the cash value. In fact, one of the things that's unique here is that in the first year, by the end of the first year, we could have 85 to 90% of the money that we put in. So the great majority of the dollars that are putting here are going toward cash value. Because of the way that we structure this, the net fee is going to be about 80 basis points or under 1% in total. And again, the reason for that is because there's a small difference between the cash value and the death benefit, and that's where the cost lies. So because we create this, they call it this net amount at risk, because we create a small net amount at risk, the actual cost is very low in comparison to really any other product. In fact, this is literally the lowest cost product that you can buy because of the way that we structure it.
And just as a corollary to that, I would like to point out that the difference is not whether this, what you talk about is the difference here is not between whole life and IUL. It's how you structure it. Because if you look at if you look at wealth formula banking, or what people, some people are calling cash flow banking or whatever, it's not any different. If you just went and bought whole life from your typical place, like Northwestern Mutual or something like that, where they don't structure it to minimize fees, you're going to run into a very similar problem.
Yep, you nailed it. That's exactly right. Both of the products that we use here are built for maximum cash, minimum cost, and as a net result, they both do a really remarkable job at creating a strong benefit with low cost.
So you're going to get, we talk about the cash value being 80-90% on the first year. The idea is you are going to pay something, but you're going to pay something that you're going to pay it sort of up front, right? And the net sum of it, as Christian said, was 80 basis points, which 80 basis points is just 0.8%. Let's just compare that to your typical mutual funds, right? So now we're talking about 3.5% fees, right? So this is not a product that is costing you much money. And then let's just add to that in addition to all these great things that this is doing as an investment vehicle, you haven't even mentioned, for the most part, all of the other benefits, because it actually is a life insurance policy, right?
Yeah, that really is a great point. I was thinking that as we go through this, but really there's a death benefit there that we didn't have to pay for otherwise. So you could save on the cost of your term insurance because now you haven't had to purchase that.
Now it's free insurance.
Some of these,
it's free
creditor
insurance
protection and things like that, tax free. So yeah, you nailed it. I think those are great points.
Yeah. Okay. So let's see here. What else we have? Though this is a good question. Can a lender loan to me on a whole life to add, they said velocity, but they mean leverage. Can you use, wealth formula banking? Can you add leverage to that?
Yeah, great question. So you can, and there are people who will use this strategy, adding this leverage to whole life. The challenge that we run into there is really twofold. One of them is that whole life is incredibly safe and predictable, and it's slower to move to market conditions, right? So that's why we love it for wealth formula banking, because we don't ever have to worry about a negative arbitrage. It's going to do what it's going to do, and we don't have to worry about that. In this case, what we want is for it to be more quick to react. And so because of that, because we're relying on market performance, it allows us to create a more dynamic spread. So our upside ends up being dramatically higher. The second thing that exists here is that most companies are using most of the best whole life companies right now are using what's called direct recognition, which just means that your loan rate and your crediting rate are going to be exactly the same. And I don't want to get too far into the weeds on this, This again is really important and really powerful from a wealth formula banking side of things. But in this case, we want to make sure that we're creating an arbitrage. We want to make sure that we have a difference in the interest that we're being, the loan amount that we're paying versus the interest that we're being credited. It goes back to that slide that Rod showed, where in a given year I could make $120,000 when my loan rate was 5% and my interest credit was 10. Hopefully that makes some sense. We're happy to go through it with anybody on a more individual level.
I would just add this, as my own opinion or commentary on this, is that there really would be no sense in adding leverage to wealth formula banking, the whole life version, because the whole idea there is you're using that as leverage so that you can buy cash flowing assets, and then so that's what gives you leverage, and that's what creates this whole
that's an important point too. So if the question is, well, can I add it to whole life? The answer is yes, but I hit on the reasons why you wouldn't. But like you said, Buck, there'd really be no sense in adding it to a true wealth formula banking strategy, because again, we want to have complete liquidity, where this is in a box. It's a set it and forget it. That's money that I'm actively using. It's going to enhance the investing we're doing across the board.
Right. So again, just for clarity, in this case, you're using wealth formula banking, you're using for leverage. And in the case of Velocity Plus, it all comes in a box. Don't touch it. You're not going to borrow from this. I mean, you could if you absolutely needed liquidity. It's available to you. But the whole point of that is to let it grow at this significant rate and not touch it. That's the big difference here.
That's exactly it.
There was a question, what sparked the change and why is it available to us now? So the idea here is, I think the question is really, we talked about how this product, for the most part, was really something that was available to the high net worth. I think, products just evolve over time, and, it's a matter of us finding ways to make them work for you. Is there anything else to that question, really, Christian?
Yeah, I can add just a little bit of commentary. Think about managed accounts, right? So this goes to your point, Buck. Managed accounts used to exist only if you had $1 million portfolio. And then over time, it moved down to 500,000. People realized that it was maybe a little bit better than having my broker churn the account. And so they started to lower the minimums on that to now you can get a managed account at 25,000, right? So in that way, that's a part of it. But one of the things that's really cool here is that we're on the cutting edge of this, because the group that we work with, the owners of it, who at that time did not fit into that ultra high net worth world, were interested in being able to use the same kind of leverage that they were creating for their clients, and worked tirelessly for 6 years to put together a product that the insurance companies and the banks got on board with because of the soundness of it. So ultimately, long story short, it was created out of a desire to make it available for themselves, and then only then were they able to then roll it out to the general public. So yeah, that's a great question.
Next question, and this again, you've sort of answered this, but doesn't IUL carry significantly more policy charges than whole life, subject to change over time at the company's discretion? How would elevated IUL policy charges affect overall returns using this strategy?
Yeah, this is Rod. I'm going to jump in on this one. I think the key to the answer to this question goes back to Christian's comment earlier. We're taking as much as we can out of the hands of the insurance company in terms of the charges and things like that. In other words, we're reducing the costs just as much as we can. And by the way, that also is our own the compensation that we receive by being involved in the transaction. Part of what we're reducing is even what we're going to receive. So in other words, we're just cutting it to the very bottom of what we can. And so the answer to the question is, yeah, the company has some leverage. They can make adjustments and things like that. But again, so maybe instead of 80 basis points, it's a full percent or something, right, over the life of the policy, if they were to make any of those adjustments. But again, the relative to other options out there, and really in comparison to what we're gaining in terms of the leverage and the the positive spread and ultimately the tax-free income that we're taking off of it would be minimally impacted by those types of changes.
So consider this. What we want to do is we want to use companies who specialize in index universal life. So we have to ask ourselves this just logical question. If I want to keep my business on the books, and by the way that we structure these, we eliminate what they call a surrender schedule. This is totally unique to this world, right? So anyone that's bought an index universal life knows that generally universal life carries a 10, 15 year surrender schedule. Because of the way we structure it, because of the way we take our compensation, there is literally no surrender schedule. So getting back to my original point, we're also using companies who specialize and are considered index universal life companies. To the extent that they're willing to raise it means that they're likely to lose business. So their product has to be competitive. So anyway, I think the question was, well, can they move things around? The answer is yes, there is room to do it. And yet if they did, there's always going to be a company out there who we can move that money to because there's no surrender charges at all inside of the policy. So hopefully that's a helpful kind of context for what we're doing here.
The next question here, are there caps on the yearly contributions to the policy? In other words, I think we would use 20,000 as the contribution. That's just a starting point, right? I mean, it depends on the size of the policy, and I mean, you could do something, 4 or 5 times the size easy if you. It just depends on how much you have, how much your net worth is, all that.
Yep, that's exactly it. So there's not a whole lot more for me to say. Minimums end up being somewhere, depending on age and things like that, around 20,000. But as far as the upper end of that, if you're financially qualified, we have people who are putting, couple $100,000 in or more. So yeah, that's not an issue. It's anywhere between that minimum of about 20,000 up to what an individual could potentially feel comfortable doing based on their individual situation.
One of the things I want to bring up, because I think it's a good thing to know, we have a number of people who are part of groups. You might be in a medical group or a dental practice or something like that, and you help make some decisions. There are some advantages if you can get your practice or your group to potentially look at this as something of a group-wide opportunity. And can you talk about that? Because I think this is something that you guys have seen already, and people are excited about it.
Absolutely. So we talk about those minimums because what we're doing is we're talking about things on an individual basis. But this is a really great point. We're hoping that in the not too distant future, we'll have a webinar out specifically talking about the value proposition to use this as a group benefit plan. Again, as an alternative for like deferred comp or other retirement plans. So there's a couple of really significant ones. One is that we basically eliminate minimum contributions. So that's a really significant piece. The other thing is that it becomes what they call guaranteed issue, which just means that there's no qualification from a life insurance perspective. Everybody that participates is qualified. So for both of those reasons, that becomes a really significant value. And then if you fit into this category of someone that has employees and wants to add unique benefits to capture or to keep key employees, then there's probably no better way out there than to provide for someone this kind of a value.
That's a good question here. And I don't want you to spend too much time on it because it gets a little bit technical, but who's the counterparty for the market downside? Because we're talking about only taking the upside and not taking the downside. This is something that you can spend a lot more time on for those who are interested in it. But yeah, can you just kind of talk briefly about how this works? Because it is. I mean, it sounds like too good to be true, right? So how does this actually work?
Yeah. So like you said, not to get too bogged down, but just at a high level, when we use traditional universal life prior to the existence of index universal life, it was just a fixed or the going interest rate. So what's happening in index universal life is that we're literally forfeiting that fixed interest rate or that going interest rate, and then we're taking, let's just say we had $100, I'm going to take 5 of those dollars and I'm going to purchase an option. So just like you create, well, let's put it this way, in an option situation, if the market's up, I end up in the money, right? And if the market's down, I end up out of the money, which just means my option expires worthless. That's where my zero ends up coming in. Yeah. So again, it's just understanding that kind of basic premise. And that's one of those things that we're happy to get into more detail on for anybody that's interested in getting into those details on a one-on-one basis.
Yeah, it's really an options play. So if you understand options, it'll be a lot easier. But I think most people, a lot of people don't. And so I'll let Christian answer those questions one-on-one if you like. The next question is, does it have an option? But this is, again, it goes back to the fact that this is a great thing to have, even if, outside of the fact that's making you money. It says, does it have an option for a critical illness rider?
Yeah, great. Another great point. Like, I wish we had more time to just hit on all of the key benefits. And so the answer to that is just simply yes, there is an accelerated death benefit for chronic illness. And of course, the death benefit's relatively significant. So I have the ability to accelerate for those types of issues. It's really based on the same criteria that we would use in a traditional long-term care situation. In other words, if I lose the ability to perform 2 of the 6 functions of daily living and a doctor is willing to sign off on that, I then have the ability to not just accelerate or not get just the cash, but to actually accelerate and use the death benefit while I'm living. So a really great point and another interesting benefit. So I'm glad that they asked the question.
There's a couple questions here that I think I'll combine and try to answer them myself, because it says, why would anyone do wealth formula banking if you could do Velocity Plus? And can you discuss the key differences and considerations? To me, and this is a very good question, because I think really what it is they're completely different purposes to these products, right? I mean, wealth formula banking, for the most part, this is a product that's best for you if you're really planning to use it for cash flow investments. You can watch the webinar. We've got it archived as well in Wealth Formula Banking. But the goal there is ultimately to take cash value, cash value that's growing at a compounding rate, borrowing it at a simple rate, and deploying it into a cash flowing asset. So effectively, you've got money growing in 2 places at the same time. That is double dipping. That's the leverage, right? That's the leverage and velocity and everything that we talk about. That's the value. So if that's something that you do on a regular basis or something that you'd like to do on a regular basis, that is a great account to have. Now, I should point out that's something that I like to do. So it makes sense for me to have a wealth formula banking account. Now, Velocity Plus is a completely different animal. Let me tell you why I want to do this, right? So for the last couple of years, I've been waiting for this stock market to crash, because I'm looking at the fundamentals and I just think, wow, how is this thing going to keep going up? We're in the long, and it's crazy. I mean, it's just insane. Like every day, I mean, I think as of we had some volatile moments recently in February of 18, which is when we're recording this. But until then, it was positive almost every day, or didn't lose more than 2% or 1% for almost 2 years straight. I mean, that's insane, right? So I'm looking at the market and I'm expecting it to fall. But in the meantime, the joke's on me, right? Because everybody's saying, hey, Buck, you're missing out on this great stock market, right? So for me, this is a great opportunity to say, hey, I'm going to participate, but only when the party's on. And when the lights go off, or when it's a game of kids play the chairs, the musical chairs, right? And the light when it stops, the music stops, I want to have a chair to sit in, right? That's why I'm doing this, because I want exposure to these equity markets, because they're probably going to continue to go up. And when there's a crash, that's okay too, because the next year, usually what happens is you have a huge year the following year after a crash. So I'm happy with that. So again, just to point out, this is just a different investment, right? It's a different investment. And frankly, it's really easy to do. You don't have, you've got a bunch of bank leverage. It's in a box. You sit there and make it part of your overall portfolio, and boom, 15 years later, you got a pile of money. So hopefully that answers that. Christian, do you have anything to add to that?
No, I think you nailed it.
Yep. Okay, good. Why are the banks willing to lend on this? Is it solely because they know the strategy works and that they'll get paid? And I think the answer to that is, of course, the banks are never going to, ultimately at the end of the day, these things are guaranteed by you, your life, right? I mean, that's really what they're guaranteed by. So anything else to say on that?
Yeah, so the banks like this for a couple of reasons. Number one is because the companies, these insurance companies that we're using, are very solid and consistent, been around a long, long time and have a great track record. And so the banks take comfort in that. Number two, the strategy itself, especially because of this portion that we're contributing, that creates an immediate cash value to the point where there's always going to be much more value in the policy than what there is a loan outstanding. And so from a collateral standpoint, it's solid and secure. Even with, a scenario we looked at a minute ago where we may have extended years of low or no performance in the policy, we're never going to be at a point in those kinds of scenarios where the policy doesn't have plenty to cover the collateral. So the bank is doing what a bank does. They're lending money and they're receiving interest on it. And so they actually feel really good about this.
And the reason they do it at such a low interest rate is because, as both of you alluded to, there's really no risk to them. So they're willing to do that.
To put this into perspective, what investment can a bank look at while they're underwriting and say, this survived the Great Depression, this survived effectively hyperinflation in the 80s, and still profited? There's nothing out there that can say that. There's nothing out there, right?
So, yeah, you got it. That's it.
I mean, you got it. Ultimately, that's, to them, this is a no-brainer. Of course, there's never a guarantee in life, but when you underwrite for the risk of the Great Depression and for hyperinflation of the 80s, you're not going to get much better risk profile than that. And that's why the banks love it. So that's basically it. Guys, it looks like that's it for questions. Now, I want to thank you guys, first of all, for doing this. And I don't know if there's anything else you have to add, or are you good?
No, I'll just say thanks for having us. It's been a pleasure, and we appreciate the opportunity to spend time with everyone today.
All right, folks. Now, what I will tell you is that, again, I am very, very bullish on this product. I'm super excited that it's available to so many people now, especially, for those of you who are interested in it and have groups. You should seriously think about it too. This is just a great way to have, just think about your options right now. If you want exposure to the equity markets, and basically you can either go out there on your own and hope and pray that the market continues to go up and that you won't want to retire in one of those years where you have a 30% or 40% a correction. Or you could just say, okay, I want exposure. I'm going to take pretty much all the upside after the leverage. I'm not going to take any downside. I'm just going to contribute for 5 years. That's all I'm going to contribute to for it. And that's it. To me, this is a no-brainer. And, hopefully it is for you. If it's not, that's fine too. But I'm glad you got exposure to it. What I would highly suggest, at the very least, is that you click the button here and get a free consultation with Rod and Christian to see if this product's for you. So go ahead and do that now. And with that, I'm going to leave you. This is Buck Joffrey, and thanks for joining us tonight.